Hey everyone, this is Robert Keens with goldsilverpros.com. It's Thursday, September 17th, 2020. I have two very special guests here today. I have Nick Barisheff, who's the CEO of BMG Group, and I have Stuart Englert, who wrote the book Rigged, looking at the data around the manipulation of the gold market. Gentlemen, how are you doing today?
Very fine. Thank you, Robert.
How are you?
Doing very well. Thank you guys for joining the program. I know we've talked to both of you in the past. I know both of you were at my conference, the Monetary Metal Summit here in August. And definitely appreciate you guys contributing to the channel. Kind of wanted to start off with you for a moment, Stuart, on your book Rigged. If you can give us a little bit of a rundown why you wrote that book and what got you interested in looking at the precious metals market.
Well, I've always been concerned about the national debt and started looking at what allows the government to continue to borrow and spend money, it doesn't have. And I guess about a dozen years ago, I ran across the Gold Antitrust Action Committee and started looking at, their stories and their data, and actually went to Chris Powell, the Secretary Treasurer, and asked if he'd like to write a book. This was about a year ago, April. And he said he was, pretty busy maintaining his website, and he really didn't have time. So last fall, I dove in and wrote the book. I looked at GATA's documentary evidence on their website. They've got an extensive archive. And I put together this short book that shows that the United States government and the bullion banks and the Federal Reserve have colluded to manipulate the precious metals markets and suppress gold and silver prices.
So, and I got a copy of the book a while ago and ordered some more, and my hat off to you because you've done a very good job and simplified it into like digestible terms, because a lot of the materials that I've read over the years, are highly technical and complicated, and you'd lose the public. But you've done an excellent job on that book. It only takes about an hour to read, and you get the gist of the whole story.
Well, thank you so much, Nick. That's what I set out to accomplish. We insiders, so to speak, as gold and silver bugs, kind of talk amongst ourselves, but I think the general public needs to know this story. And I'm a journalist by trade. I've always tried to write stories that the average person could understand. And that's what I set out to do with this book. So thank you very much.
Well, and the thing that you end up in the book, which is how I felt, because the first real book, as I was setting up the fund, because I started setting it up in 1998, and it was about that time that Frank Veneruso wrote his book, which was called the Gold Book, and it's a very big, it's like a proper document and everything, but very technically complicated. But that was when, at the time, he estimated, this was 1998, that there was 8,000 tons of leased gold outstanding at the global central banks. And then in 2002, he recalculated the number to be 22,000 tons. And the central banks only purport to have 34,000 tons. So that's an amount of gold that just doesn't exist to repay. So that's that's kind of where I started from. And when you read in any of that material, the conclusion you come to is, okay, so they have manipulated, but eventually the manipulations come to an end. And many people compare that to, like holding a balloon underwater. The deeper you go, and when you let go, it comes shooting out the top like a rocket. So that's what's going to happen when this whole manipulation game blows up.
So, Nick, we were talking before the interview about some ways in which there are legitimate trade on the market and illegitimate trade. Can you outline some of the differences for people who are not familiar?
Well, because we dealt with the physical precious metals division of Scotia Macauta, we didn't have anything to do with the COMEX because I looked at that early in the game, so okay, I'm not going to play in that league. So the thing that happens when a bullion dealer like Scotia is dealing with a hedge fund or our mutual funds, and let's say we have redemption. So let's say for argument's sake we have $1 million redemption. We send them back $1 million and they buy that at spot price, at the moment. But they can't be at risk because tomorrow the price could go down and they'd lose money on just a daily trade. So they would right away hedge the position by shorting on the COMEX an equal amount. So they're even the minute they bought it from you. So that's kind of the legitimate way, because if you're a bullion dealer that's, or a coin dealer or anybody that's buying back on a daily basis at spot, and you don't know what, the price is going to be tomorrow, you can't take the risk that you bought it today at spot and tomorrow it's gone down. And so you're not going to keep it in inventory until the price goes back up, then you can sell it. You would hedge it right away. So that's what you do. The other thing, like when it comes to leasing gold, the legitimate way of leasing is that when a mining company finishes all their exploratory work and paperwork and they're ready to start into production, they then have to raise a whole bunch of money to get into production, buy the equipment, whatever the case may be. So you can do an equity issue, a debt issue, or you can borrow gold from a bullion bank, sell it, and repay it out of production. So that's like selling covered calls. Mm-hmm. Again, totally legitimate. So those are two legitimate methods. When you get it to illegitimate is when the players don't have and can't get any gold. So a mining company can repay it out of production, but if a hedge fund sells naked calls, well, where are they going to get the gold from? Mm-hmm. Okay, so that's the problem, where the problem starts. And on the COMEX, you can sell an unlimited amount of puts if you're one of the major players. And if you buy a large amount of calls, you're going to get a call from the COMEX asking you what you intend to do, like whether you're going to take a delivery in currency or the precious metal. Mm-hmm. And if you say you're going to take delivery, then they're scrutinizing the trade very carefully. And when you go back to the late 70s, when the Hunt brothers, bought the silver, their mistake was they bought it on the COMEX and intended to take delivery. But it was amount that the counterparties couldn't possibly deliver. So there would have been a huge default. So the COMEX changed the rules, increased the margin requirements, and in a heartbeat bankrupted the Hunts.
Mm-hmm. So they changed the margin requirements not only on Hunt's new position, but on their existing positions. Is that correct?
That's right. So and they did the margin call, which they couldn't meet.
Mm-hmm.
It's like the casino always has to win. Once you figure out the game, kick you out of the casino, right?
Well, at least the casinos maintains the same rules on the COMEX. They can change the rules at will.
Okay, gotcha.
So it becomes that much more difficult to win if the rules are a moving target.
Sure.
So what the COMEX will say, and I've researched this particular topic a little bit, Nick, and what the COMEX will say is we're increasing the margin because the overall risk to the exchange is increased if we have a lot of open interest, because as I understand it, the COMEX has to guarantee their side of the trade. So could there be a legitimate reason why they're raising margin as well?
Well, they've got two mechanisms, the margin, and then their fallback mechanism is that they can force you to settle for currency, not for the gold or silver. And then it's considered an okay trade. So that's really against the rules. And the problem with the COMEX is that it's not just gold and silver. Let's say you and I are farmers, we're busting our ass, growing whatever crop it is and coping with the weather and all the other conditions that a farmer does. And we're hoping to get a certain price when, at harvest time. And, a couple of brokers in Chicago are having a couple of beers and say, well, how about we short the wheat market tomorrow? And, they knock the shit out of the wheat market, and you and I go bankrupt as farmers.
Mm-hmm.
Not a good way to play the game.
So for those who are new to understanding the COMEX, explain the concept of naked shorts in the futures market. I'm assuming that means any short in which they don't have the metal to back it up.
That's right. Like so if a mining company, as an example, sells futures contracts on gold or silver, and they can stand for delivering and deliver it at a production, but a hedge fund that doesn't have any gold or silver then can't deliver without going to the market and buying it, which seems to be what's starting to happen now. That the typically 90% of the accounts are settled in currency. Now the settling in physical is growing with every passing month. But you'll notice that the day or two before options expiry date, the gold and silver prices get hammered.
Mm-hmm.
Strange coincidence.
Of course. So there's a lot of debate going on the internet right now, particularly in response to an article that I wrote and an interview I did with a gentleman talking about the increased physical deliveries that we've been seeing since this spring. So we've been seeing increased physical deliveries, and some people that have experience with the market are saying that the seller initiates the delivery process so that they dictate whether or not you can take delivery of the metal on that contract. Although my understanding is the contract is written as such, a loan can stand for delivery, and doesn't it have to be the exchange to come in and decide whether it's cash or delivery, or do you know how that process works?
Well, it's unclear. It's just that if the seller can't deliver,
mm-hmm.
then to keep things going, the exchange can force a settlement in cash. So the seller,
mm-hmm.
Does have to give you currency, but not the physical. So it's just a complicated process that can be done. And over the years, there's been an enormous amount of articles written about it, and nothing's really changed.
Mm-hmm.
Since I started the company in 1998, being the same old problem throughout. But now what's happening is of course, starting with Deutsche Bank trader, and then J.P. Morgan and
mm-hmm.
Nova Scotia. All the cards are falling as they're going through them and cutting deals. So in order to cut a deal, you have to turn everybody else in,
mm-hmm.
and that's what's happening.
We saw that just this morning. There was an article out in Bloomberg, September 17th, about one of the Deutsche Bank traders saying the two experienced traders on the desk that mentored him, and one of them was his boss, I think, taught him how to basically manipulate the market. And that was the normal. That's what he was supposed to do every single day. His role to manipulate the precious metals market. I think that came out of the court hearings. Uh,
That's
just
right.
this morning.
So
Yeah.
the cards are kind of starting to fall,
Mm-hmm.
and as they get closer and charge somebody, then they do a plea bargain by turning everybody else they deal with in.
Mm-hmm.
So that's what's happened, and that's where, as you're aware, Scotia's totally shut down Scotia Makata, the entire precious metals division.
Mm-hmm.
Um, and they were fined 120 million, I believe it is. But that's probably a drop in the ocean over how much money they've made over the years.
Mm-hmm.
But who are they going to implicate? On the other side, they weren't trading by themselves.
Mm-hmm. So now this has some momentum behind it, and so potentially we'll see more court actions coming a little bit faster. It kind of started with Deutsche Bank, and now it's the dominoes are falling now.
Right. And Deutsche Bank is a huge vulnerability, because even before COVID, this stock was kind of at the edge of the precipice. And Deutsche Bank is so interrelated and interconnected, and I think the derivatives book is big as JP Morgan's and so on. And so if it ever failed, you'd have cascading failures like you've never seen before.
Mm-hmm.
And including that they're a major authorized participant for the ETFs. So anytime you take out the authorized participant, the original lessor of the bullion and the ETF, have got to settle up, and the bullion really still belongs to the lessor.
So that is what I'm getting questions about now, Nick, and I keep referring people back to our interview earlier this year where we talked in detail about the GLD and your study of the authorized participant agreements and whether or not that gold is actually owned by GLD. Is it leased to the GLD? Do you want to speak a moment about how the GLD works?
Well, people are under the perception, because we get that all the time, because the first thing people look at is the expenses associated when it comes to a fund. And our retail management expense ratio is about 2.25.
Mm-hmm.
Large part of that is because we have allocated insured storage. If I was to let Scotia store it on an unallocated basis, there'd be no storage fee, because they could lease it. Okay, so people superficially start looking at that, and they say, well, the GLD is a half a point. Well, half a point isn't enough to cover storage fees and insured storage fees. So then without getting into the legalities or the complexities, is when money comes into an open-end mutual fund, then I, as the manager, go into the markets and buy the product, whether it's an equity or a bond or gold or silver. So you just buy it, and that becomes part of the assets under management. But the thing is that when you first read the prospectus, but then you have to read the authorized participant agreement, you look at, well, the public doesn't deal with the ETF. The ETF doesn't really do anything, but is the trustee for the holdings. The people that do everything are the authorized participants, and they can sign an unlimited number of authorized participant agreements, which are typically the big brokerage houses and the banks.
Mm-hmm.
So then you think, well, is a bank going to go to the market and buy, let's say, gold at spot price, contribute it to the ETF at net asset value, and get shares of the ETF at net asset value and sell them to the public at net asset value? No chance of that. I guarantee that. Okay, because for all that work, the slim arbitrage spread is nowhere near enough.
Mm-hmm.
But if the authorized participants borrows the gold, contributes to the ETF gives them shares. You sell shares to the public, and they keep all the money. Okay, so now they have a liability to the bullion bank, to the central bank for the borrowed gold. The central bank is happy to lend it because now they don't have any storage fees because it's temporarily parked in the ETF vault, but title never changed, just like it does with any lease agreement. So that becomes a very lucrative deal. It becomes much better than collecting management fees. Okay, so that's the main flaw. The flaw, though, becomes is that in the event of an authorized participant becoming insolvent, like Lehman Brothers did, but they were able to step in and bail that out, okay? Because that would have, caused probably a collapse in all ETFs when people realized what happens when an authorized participant goes bankrupt. Okay, so that's the thing. So they were able to shore it up at the Lehman time, but when you get to gold, it becomes very difficult to patch it up because the gold just isn't there to patch it up with.
Does it matter that the GLD provides an audited report of their gold bar holdings? Because let's say they have how many ever gold bars, and Bureau Veritas, I think it is, it does their report, prints the report.
Yeah, but see, the audit report is difficult to do because you could go to the vault and say, here are the gold bars, go ahead and count them and check the serial numbers and whatever. But that doesn't tell you whether they're leased or not.
Bingo.
Okay. So that's the problem. The audit, you have to carefully look at what the mandate of the auditors are. And that's been the problem of auditing the Federal Reserve gold holdings, right? And so it's not enough to go and say, okay, you've got X number of bars in the vault, so everything's okay. Well, they might have been swapped, leased, whatever, and they're not temporarily there. And this is where you've got these anomalies in accounting, right? So when a central bank leases gold, it's still an asset on its balance sheet.
Right.
Okay. So you can't tell it. It shouldn't be that way. It should say, well, you no longer have the gold asset. You have an IOU from whatever bullion, authorized participant or bullion bank, right? Because having an IOU is not the same as having the gold.
Well, and couldn't that also be true on the COMEX? How do we know that all the gold sitting eligible is theirs? This is something I brought up in my video. The COMEX released, and this is something Ronan mainly caught off of Bullion Star a few months ago. BMG Group released a report and said, we have all this eligible gold, but we're going to knock it down 50% because there's no consensus from the depositories who it actually belongs to. In other words, the chain of title had not been maintained. Right. But their excuse was, well, we can move that 50% up or down because in reality, we don't know if any of it. So all of this gold that's been represented to be on COMEX, it's in the eligible category, which is not, by the way, posted for a futures contract.
Right.
How do we know who owns
that's
that?
Right. When I was setting up the fund, the implementation logistics issue, so I took 4 years to deal with the Ontario Securities Commission and another year with all the other provinces. So that was one challenge. The other challenge was, how to buy and store the gold. So originally, I considered, just having a futures contract when money came in, just buy more gold in terms of a futures contract and take delivery at the end of the month and so on and so forth. But when I looked into it, I decided against that, and that's when we started dealing with the physical division of Scotia Macadam. And when it came to, see, in a Canadian mutual fund, the custodian has to be a major bank, okay? so Scotia Makata would be the seller, and the custodian would be the Bank of Nova Scotia. But the thing is, we had to invent the custody agreement, and it was only because I'd been in the real estate business. I was the manager of the investment division at A. LePage, and so I was totally familiar with, how you get title to real estate.
Mm-hmm.
And it always amazed me that in some cases people have more in gold than they have in their own house, and then they don't think of the same precautions about title.
Mm-hmm.
So the original custody agreements had to be invented from scratch, almost from real estate precedents, to make sure the title flowed the right way.
So wait, let me stop you right there. So what you're saying is, in the gold market, the title procedure, the standard title procedures are not as robust as what you saw in real estate.
Typically they're not, but that's what I changed when we did our funds.
Mm-hmm.
So that they were. And that's the key element. It's not about the expense ratio. It's about making sure you actually own the gold.
That's
and,
right.
and we'd gone, because I'd have questions from investors say, well, what happens, because we're beside a small airport. So, well, what happens if an airplane hits your building, all the employees die, and your computers get burned? And what happens to the gold? And so our custody agreements take care of that. Okay, so then under that, and I usually say, well, have you asked the same question of the bank? Okay, or your broker? Okay, no, I didn't. Well, a lot more vulnerability to that happening there,
Mm-hmm.
and all your paper going up in smoke. So we have multiple security on-site, off-site. So all the bullion is tracked. So if BMG disappeared, if Scotia disappeared, the trustees stepping in could figure out whose gold that is. Okay.
So your custom custodial agreements ensure that there's not double counting, but typically that may not be the case in the gold sectors, is what you're saying. You had to develop that for your own
That's right.
fund.
Right. Now the thing is that no matter how good the agreements are, you could never prevent fraud. Okay,
Mm-hmm.
so the thing you look at it is, could an employee of Scotia, where we have custody, still commit fraud?
Mm-hmm.
And that would be difficult and unlikely. Okay, but you can't contract your way out of fraud.
Mm-hmm.
Essentially.
But for exchanges or depositories that maybe don't have as strong agreements, it would be easier to conduct a fraud, so that even if you're looking, say, at the
if you're
COMEX
one of the big players,
yeah,
you're going to do agreements where you're not guilty of fraud. Okay?
Right.
You just have to read the fine print.
You can do whatever you want, but you just can't be guilty of fraud, even though it may be fraud.
That's right.
That's astounding. That last couple of minutes, I want everybody who just watched this video to rewind it and listen to what Nick said again, because it doesn't matter what's on the surface. And that's what I've been talking about for the last 2 months. It doesn't matter what's on the surface, the details matter. And in the gold market, title is the chain of title and chain of custody is a lot different than we see in other established markets like real estate.
Well, and you see on a fundamental legal basis, when you're dealing with hard assets, whether it be real estate, a car, a boat, a plane,
Mm-hmm.
the same principles apply.
Mm-hmm.
The seller says, okay, I own this asset, it's free and clear, I have the right and ability to sell it, and then they describe it in detail and then convey it to you. And
Mm-hmm.
you accept their representations and warranties, you do whatever checks you need to search title if applicable,
Mm-hmm.
and then title is converted to you. So we have that, when we buy the gold, and then there's paper trail that goes in, because most people, the bank tells them, oh yeah, you own so much gold, and say, well, give me a statement, and they give you a statement that says you own X number of ounces. That's it. Well, that means you don't own anything.
Mm. So Stuart, going back to your research, I know you've been following gold and silver for about 15 years. Does any of what Nick said surprise you at all? Is any of this new to you?
No, it really doesn't. You know, and my book kind of goes right along with what you're talking about, but you go in a much grander detail than my book. I kind of hit the surface for the general reader, people that don't know all these internal mechanisms. You guys are in the weeds, and you know, I'm up in the trees, so to speak. But no,
but that's what I liked about your book, because for the general public, even for the retail financial advisors, that book, it hits the spot exactly. Because, like, if you were to read Venarusso's 98 book, it's too much work for all these people. They wouldn't read it. It's about an inch thick, and it's 8.5 by some weird paper size. It must be like 8.5 by 15.
Wow.
So
well,
it was a $900. It was a $900 book in 1998.
Mine's only $14.99, so I think money's worth mine.
Okay.
You know, I didn't want to write an academic tome. I didn't want to. I wanted to write something to expand the audience. You know, I think we're not going to get anywhere with this manipulation story unless a larger percentage of the general public understands how they're being played. And that's the way I look at it. We can talk amongst ourselves all day, but this manipulation story has to spread to Joe Public, you know, to Joe Six. We need to get the word out, and that's what I hope my book will do. That's how I wrote it. But, you know, I'm working on another book, Nick. I think I told you about in the pre-interview. It's a financial memoir, and the last couple of days I've been recapping what's happened this year in the precious metals market. And, you know, 2020 has been both an odd and extraordinary year for many reasons, including in the precious metals market. Some would say it's unprecedented. And we're only, a 3/4 of the way done with the year. But back in January, the gold price hit a 7-year high of $1,550 over fears of war. Remember when the Iranian military leader was killed by a U.S. drone strike? Well, you know, that perked gold up. We resumed the bull market again, I guess. In February, the U.S. Mint temporarily suspended silver American Eagle sales once again. This is for like the 8th time in the last 10, 12 years, after, you know, demand exceeded supply once again. And this was before the coronavirus pandemic. After the virus lockdowns we had in March, Congress opened the money spigots. You know, the Federal Reserve lowered interest rates to near zero, and gold and the silver ratio spiked to 125 to 1 or higher. And I think that's the highest ratio since the 1930s, according to James Anderson.
But that's really the core issue. When we have geopolitical events, then you have a temporary spike in gold. It's not a long-term trend. So the difference now is that we have a long-term trend. There's no end in sight. The amount of money they've printed so far is like the tip of the iceberg, because that money was used to pay people not to work. Okay, now they're going to have to subsidize the failing businesses to keep them from totally failing. I mean, you just look at the hospitality sectors, the airlines, the hotels. I think the airlines are talking about in excess of 20 billion by the end of October, or there's 20,000 people being laid off. You know, and when you consider the airlines, like, you can't keep airlines like stored on the ground and think they're going to work perfectly fine. So when they fly again, I'd be concerned about the mechanical aspects, because I have a fairly decent sized boat. And if you don't use it, it's in worse shape than if you're using it and running it hard. So the same kind of mechanical issues happen. So there'll be a cascading amount of, problems. The sports industry, the movie industry, like they're trying to have virtual sports. It's not the same thing. Like, just isn't.
The ratings are all down, by the way. The NFL, the NHL, the NBA are all reporting lower ratings than they've had in 10 to 15 years.
Yeah, but then, who's going to pay for the stadiums that are empty?
Mm-hmm.
Or the Formula One tracks, which aren't cheap, okay, and no audience.
Back to the comics, I knew something, everybody knew something was wrong in March when the paper market essentially broke, is how some people describe it, causing spot futures and retail prices to diverge. And, this required some extraordinary measures at the COMEX. Some would say desperate measures. And I attribute a lot of the imports of physical gold into the United States to demand requests, delivery requests on the COMEX.
Mm-hmm.
Through July, the US has imported a record $26 billion worth of gold, okay? Primarily from Switzerland, but also Singapore, Australia, Canada, and Mexico. I can't find the exact tonnage numbers, but based on my calculations, it's somewhere between 350 to 400 tons. And then in July, we had silver prices followed the gold prices higher, rising to a 7-year high of $29 an ounce ultimately in August, just last month. Around the same time, we had another unprecedented move in gold, which hit an all-time high of $2,000 an ounce. And remarkably, 2 weeks later, former gold cynic Warren Buffett's company, Berkshire Hathaway, invested $600 million into Barrick Gold, which indicates to me that some gold skeptics are having some second thoughts about the yellow metal.
I don't believe Buffett has ever been a gold skeptic, because his father was I think he was a congressman or a senator back in 1933, and he was totally against, going off the gold standard, confiscating gold. And one of the books written by one of the ex-wives of one of the Buffett kids talked about how the only gift Warren ever gave any of his grandchildren, nephews, nieces, whatever, were gold eagles. It's the only thing he gave them.
Wow, that's cool. That's cool. Well, there's something else happening too. And Nick, you and I talked about this briefly a couple of weeks ago. More pension funds are investing in gold now. Just last month, the Ohio Police and Fire Pension Fund announced that it had allocated 5% of its $16 billion portfolio into gold. And that fund joins two large pension funds in Texas that own, I think it's over $1 billion in physical gold. And then you mentioned there's some Canadian.
Well, and the important thing that happened, the first fund was the Texas Teachers Pension Fund.
Mm-hmm.
And it's managed by McGuire, and he's got a couple of books out on the subject. And so my understanding was what they did was they first allocated to the ETF, the GLD ETF, and then over time took delivery of physical. So they got out of the ETF and switched it. Because I think a lot of the pension fund managers and hedge fund managers don't really know how or where to buy the gold. So the first thing that comes to their mind is the ETF.
Sure.
Like Ray Dalio's got the right attitude about the all-weather fund, which has about 9% in gold, but it's all in the GLD. And I've tried to write him several times that somewhere it went missing through the cracks. Imagine how embarrassing it would be to Ray Dalio to be talking about about the importance of gold, and then have an authorized participant fail and find his $2.5 billion in the GLD go up in smoke. Explain that to all his billionaire investors.
Wow.
So I want to reiterate, Nick, these authorized participants are the major banks. And if one of the major banks goes bankrupt through their other business, it could affect the gold fund. That's basically what you're saying.
That's right. And you see that the way ETF started, again, it starts off as a relatively legitimate thing. If you're a broker, you can borrow the equities in your client margin accounts anytime you wish without telling the client anything.
Mm-hmm.
Okay. If you're the prime broker for a hedge fund, usually the deal involves being able to borrow their assets. And then if you're a pension fund, you come to an agreement with a broker that they can borrow the assets. So, because that was all needed, because for legitimate shorting, right, if you wanted to short a particular stock, the broker would arrange to borrow that stock and give it to you, you would sell it, and then you would have to repay it back. But the actual owner of that stock that short sales took place wouldn't ever know that happened. So as long as the market's going along fine, nobody notices, everybody's happy. So then the issue came along when they invented ETF, because the first ETF was index trackers. So for simplicity, take the Dow. So you created a Dow ETF. The authorized participants would contribute a basket of Dow stocks, the 30 Dow stocks, to the ETF. They would assemble those Dow stocks from their client margin accounts or their prime brokerage accounts contributed to the ETF. But that's no different than lending stocks to somebody that wants to short the stock. But the missing other problem in the ETFs is that the authorized participant only act as market makers for the ETF in terms of managing the purchases and redemptions when there's an arbitrage profit and it's convenient. But if let's say, you had an equity index tank precipitously or began tanking 700 points a day or whatever, they'd simply step aside and wait till it became 10 cents in the dollar. Then they'd buy back. Okay, but normally they'd keep the spread, but you'd find that the ETF would go into a huge discount because the authorized participant stepped aside and weren't redeeming. It would be up to the investors to redeem, and there could be no buyers for the shares when you've got like a precipitous decline. So that's a whole other area of risk that has nothing to do with gold and silver, just the concept of ETFs.
Mm-hmm. So, Nick, you recently wrote an article about 100% gold ownership. What's your perspective on that?
Well, I'm one of the old guys, so I remember that typically when markets became very volatile and full of risk and unknowns, you simply took your money off the table and sat it out, okay? And then when the markets got stable, finished tanking, did whatever, then you went back in and bought back everything as you see fit, and you could be buying 50%, 70% less. So when you've got unruly market conditions, that's what you want to consider. The mantra of always staying invested is true in a long-term bull market, but it doesn't apply when you're standing at the edge of the cliff.
Mm-hmm.
You know, don't jump then. Get out. Now, if you take the next step of getting out and say, well, I got out in cash, but cash is depreciating and so on, so I'm losing money while I'm waiting. And the next big thing is to buy gold, because historically on any of the declines, then gold's going in the opposite direction. So by holding gold temporarily, you're going to have the gold go up, the equities go down, and then at the end of the piece, then you rebalance your portfolio with the rest of the assets, REITs, and so on. And the profit opportunity, like, again, because my background is in REITs, so in Canada, the biggest office REIT is the Dream Office REIT. It's got $12 billion of office buildings. And in 2008, when the market crashed, it crashed 84%. 84%. But the rent stayed the same, because all the accountants, lawyers, and brokers and everybody that was paying, they were paying the same rent at the top and at the bottom. So guess what happens then? The dividend yield at the bottom was 30%. 30% dividend yield forever. Okay? That's the only deal you had to do. Then you could stop investing and do nothing. But you had to be in cash. You had to be totally liquid to be able to buy at the bottom.
Mm-hmm.
And that's my point. So whenever I've looked at investing, I don't look at taking money and giving it to someone and expecting a capital gain and dividends or interest.
Mm-hmm.
I look at it and say, I'm going to take so many ounces of gold out of the bank, and I'm going to give it to you. Now, you convince me how I'm going to get more ounces back.
Mm-hmm.
Okay? And if you analyze most investments on that basis, you know, other than something like Apple or Google, you're not going to get more ounces back.
Right.
Okay? You're going to get less ounces back. So I might as well leave the gold in the vault.
Mm-hmm.
Okay?
And basically what you're describing is inflation over the return of the stock market. For example, even if you look at the stock market, if you back out true inflation, I'm not talking about CPI numbers, but true inflation we actually see in products and services we use every day. Even if you have a healthy return on the stock investment, it doesn't mean that you've gotten ahead of the game. If you just kept it in gold, and gold is at least tracking inflation, if not doing better, you would have done better just to leave it in gold.
Yeah.
Is that correct?
That's why I say we've done lots of charts, and if you do a chart of equities, but priced in gold instead of dollars,
Mm-hmm.
and it's a major losing proposition.
Mm. So, Stuart,
And it's a lot easier to sleep at nights when your gold is in the vault and under an allocated custody agreement. There's nothing to worry about.
Yeah, a good custody agreement, not a COMEX
That's right.
agreement.
Right. Which are very few and far between.
So, Stuart, what's your view on investing right now? I know you said you had some interest in the mining stocks and gold and silver. Is that primarily where you're focused at the moment?
Well, you know, I'm not 100% all in. I am not. I'm more conservative than that, or maybe less conservative. I don't know if you call gold conservative, but you know, I'm looking at many monetary and geopolitical issues now that seem to be coming to a head,
Mm-hmm.
and it looks like we're not too far away from either a currency reset or a dollar devaluation, probably a precious metals reevaluation. And the first thing I'm looking at to gauge my own portfolio is the national debt and the deficits, right? You know, when the fiscal year concludes at the end of this month, the US government will have spent more than $6 trillion for the first time ever. And its budget deficit will top $3 trillion for the first time ever. Now, if this hyperbolic spending and borrowing persists, the US dollar and debt instruments are going to face increased pressure and weakness. And this is going to strengthen precious metals demand and prices. And that's when I might go all in, you see. But I'm gauging it, I'm watching it. You know, the second thing I'm watching is this upcoming election. regardless of the outcome in November, we're going to have uncertainty, chaos, and likely violence, you know, that will continue to ensue in our divided
And no
nation.
matter who wins.
Yes,
that's right.
absolutely. And that could elevate the precious metals markets. Finally, not finally, but globalists also are going to be meeting several times next year, both virtually and in Davos, Switzerland, to discuss the what the World Economic Forum is calling the Great Reset. I guess you've heard about this. The globalists claim the world needs a great reset of social and economic systems. Now, I don't know how the global economic system can be reset without resetting the monetary system.
Right.
And to me, you know, gold is solid. Also next year, the International Monetary Fund is set to review its strategic drawing rights, okay? SDRs are based on a proportioned composite of the world's 5 leading currencies. That includes the dollar, the euro, the Chinese renminbi, the Japanese yen, and the British pound. The Chinese currency was added to the composite in 2016. And SDR's composition is evaluated every 5 years, and that's scheduled for review next year. I'm expecting the US proportion of the composite, which is now 42%, to decline and China's to increase. And I keep asking myself, why is the British pound still in this, other than they control the gold market, okay? And by the way, the original SDR equaled 0.89 grams of gold. That value was abandoned in 1973 with the end of the International Gold Standard. But who knows? Maybe the SDR will be backed by gold again.
Well, the other thing for the SDRs is one of the components is going to be, apart from the allocation per country, is what the country has in official gold reserves. Now, China, official gold reserves at the central bank, last I heard, it was about 1,600 tons. In the U.S., purportedly 8,000. China has stated that their objective is to have more than the U.S., i.e. 8,000 tons. Now, what China has been doing, to the best of my knowledge, is they've been buying physical bullion in the sovereign wealth fund, because the sovereign wealth fund doesn't report to anybody. Okay, it's not like the central bank. So the amount of gold being held by the sovereign wealth fund is much higher. But if you trace the flows into China, you know, where is that gold going? It isn't going to the peasants. Okay. So the thinking is that when China has finished buying the gold, i.e. when they're over 8,000 tons, they will shift it from the sovereign wealth fund to the central bank, okay, and make an announcement, oh yeah, so by the way, we've got 10,000 tons of gold, and we'd like a different position in the SDR than we currently have, because we now have more gold in the U.S., so we should have a bigger position in the U.S. But the problem that that's going to entail is that if China says they've got 10,000 tons, then they're going to say, well, wait a minute, where did you get the 10,000 tons from? Because if you look at all the reporting, like entities like CPM and GFMS, everything's been accounted for.
Right.
So there isn't a missing 10,000 tons. Okay. So obviously what that'll be is leased gold that was borrowed from the Western central banks and then reminted in Switzerland and then sent to China, never to return or be repaid. What does that do to the Western currencies?
And how do they go about getting that gold back if it's been remitted, the gold marks are gone, and you have these crappy custodial
the other weird thing about gold leasing. So if you lease a BMW, at the end of the lease, you're expected to return that BMW, not a BMW, okay?
Right.
But in the gold market, if you lease bullion bars, which are typically 400-ounce LBMA bars, you can return any 400-ounce LBMA bar. So that means in the meantime, if the borrower has melted it down, made it into jewelry, sold it, made it into kilo bars and shipped it to China, there's no longer a straight chain of reference. And the bullion bank is effectively naked short, okay?
Mm-hmm.
So they don't have the gold. It's long gone to some other form. Again, totally legit. And they would have to go into the market and buy some 400-ounce gold bars to return them, okay? They don't have to return the specific serial number. So when Germany asked for its gold back, and I forget how long, but it was an extremely long time. They could have sent it back in a couple of 747s the next day, but it took them months or years. And what they got back were not the same gold bars. So they obviously went out and bought the bars and accumulated them. And maybe that's why what they're doing now is having to cover the short positions, or because more and more countries are asking for their gold back.
Mm-hmm.
So, they have to buy the gold to return it.
And that's why the COMEX has, for their role in this, has increased the overall number of assayers and refiners that can contribute gold. They doubled it basically for gold and silver. I think it's back in June or July to the COMEX. Okay. And they suspended their what they call chain of integrity requirements temporarily. And a lot of those refiners and assayers are in Russia, Uzbekistan, Kyrgyzstan, and China. So maybe that's some of the gold flowing back in. Who knows?
One indication to me that gold is returning to the monetary system is the Basel III Accord, which reclassifies gold as a tier 1 no risk asset among the world's central banks.
But that's where to do the reset
has been delayed by the BIS several times since 2015. It could be again, but they're supposed to be phased in beginning January 1, 2020. And I think this is all coming to a head with a redistribution of the gold stocks around the world.
Mm-hmm.
I'm also watching the sanctions and saber rattling between the United States, Russia, and China, which indicates to me that geopolitical and monetary issues are coming to a head. We went from a currency war to a trade war. Now some are predicting a hot war. If you read the military news, China's leader just in the last week or so instructed his military to prepare for war. So,
so maybe they know the rallies of gold are going to come out, right? So they're preparing.
Jim Rickards has talked about that a reset has happened many times in history, and you could wake up one morning and, on Friday the gold price was $2,000 an ounce, and on Monday it's $10,000 an ounce, just like that. Okay, and if the U.S. in fact has 8,000 tons, it's to their benefit to reset it for $10,000 an ounce.
Absolutely.
Solves all the debt problems right there.
Mm-hmm. Yes. All right, guys, this has been an absolutely wonderful and illuminating discussion on the heels of what we've been talking about, not only at the conference, but about the COMEX and the gold flows. I'm going to give you guys one last topic if you want to discuss. We haven't discussed here before we wrap up the interview. We'll start with you, Stuart. Any last thoughts?
Well, one thing that I've been meaning to address, and I haven't, the title of my book is Rigged, but the subtitle is Exposing the Largest Financial Fraud in History. Mm-hmm. And I've had a couple people questioning that, Mm-hmm. One fellow said, oh, that's hyperbole just to sell a book. But, I've been thinking about this for the last couple months. And here's the way I see it. Gold and silver prices are rigged to defend the US dollar. Mm-hmm. And since the dollar is the dominant currency in international trade, every foreign currency exchange for dollars also is rigged, along with the whole global financial system.
Along with the SDRs, yeah.
Yes.
Yeah.
The world's money supply and economy has never been larger. So the financial fraud is the largest in history. But there's an even bigger fraud, and that's that the wool has been pulled over the eyes of most Americans. We've been convinced that the US dollar is as good as gold and silver, and I would argue it is not. And that's why they have to rig the price.
Well, it used to be until 1971, because it was backed. That wasn't backed 100% ever, but it was backed. And I think that people that think that it isn't rigged are naive, because, you know, it seems to be obvious. If you had a sweetheart deal where you had the reserve currency and you could just print pieces of paper and buy the stuff that everybody works their ass off producing, I'd like to keep that deal, okay? So to think that they're not rigging it is highly naive.
I agree. And that's another reason I wrote the book, was to dispel the myths and the so-called conspiracy theories. Anybody that continues to say that the manipulation is a conspiracy theory, I encourage them to read my book. Because
and I would second that, because you did a terrific job.
All the endnotes are there. They can go down the rabbit hole. They can dispel their own conspiracy theory in their mind.
That's right.
That's right.
Any last thoughts from you, Nick, before we close out the presentation today?
Well, it's just that there's so many things, and apart from the manipulation, it's the money creation and printing, I believe is going to accelerate. We haven't seen anything yet. I mean, at some point they're going to have to face the pension deficits, okay, and you know, that's an enormous amount of money that they don't have, can't get, and the choices are either you cut the pensions of the beneficiaries by 50%, raise the contributions. That's not going to happen. None of the solutions are particularly pleasant solutions. They're going to try and keep that going. So the amount of money that's going to get printed is going to be huge. If Biden should get elected, it's going to be beyond huge. And that's a given. So I look at it that I mean, in terms of investing, nothing's ever a sure thing. But buying gold right now, in my view, is as close to a sure thing as you can get.
Yeah, I definitely agree with that. And that's why I'm pretty close to all in to the gold. Of course, hold some farmland and other real estate investments. But that's been my thesis for the last 10 years. And I agree with you, gentlemen. Thank you both for being on with us today on Gold Silver Pros. I appreciate it very much. I look forward to speaking to both of you again.
Thanks, Robert.
Thank you. It's been a pleasure.
Take care.
Take care.